In prior videos for Chapter 6, we looked at revenue recognition where we only had a single performance obligation. In this video, we look at instances in which we have multiple performance obligations. If we suspect a contract has multiple performance obligations, we must modify steps 2 and 4 in our recognition of revenue. Remember, step 2 identifies the performance obligations that exist, and step 4 allocates the transaction price among the performance obligations. Remember that a performance obligation is the obligation to provide a good or service, and we consider a performance obligation to be separate if it is distinct from other items within the contract. A good or service is considered distinct if both of the following are present. Number 1, that the good or service is capable of being distinct. That would indicate that the customer could use the good or service on its own or in combination with other goods or services that it could obtain elsewhere. And 2, that the good or service is distinct if it's separately identifiable from other goods or services in the contract. This is what we consider distinct in the context of the contract. And this would be when the seller is promising to provide goods and services individually as opposed to promising to provide the goods or services combined. Consider the scenario, for instance, if a house is being constructed. You could, maybe if you were skilled enough, go to Home Depot or Lowe's and buy wood and paint and nails and concrete, whatever else you needed in order to build a house. When you went to Lowe's or Home Depot to buy those, each one of those would be sold individually and therefore considered separate performance obligations as you purchased them at the store. However, if you were to go to a contractor that builds houses for a living, you wouldn't be buying from this contractor if you contracted them to build a house. You wouldn't be buying from the contractor distinct individual separate performance obligations in the context of the contract. You wouldn't want the contractor to then give you wood and paint and nails and glue and concrete or whatever else you needed to build the house. You wouldn't want them to provide that separately. You'd want them to provide them combined in the context of the contract. They wouldn't be separately identifiable. Therefore, in that contract, you would consider a single performance obligation with the home builder as opposed to separate performance obligations for each individual piece. The single performance obligation would then just be the house, the construction of the combined units together, the house. Let's go ahead and look at an example where we have multiple performance obligations in a single contract, and we're going to focus on steps 2 through 5 in the revenue recognition steps. This example again goes back to TrueTech. TrueTech manufactures the TriBox system, which is a multi-gaming system that allows other players to compete over the internet. Now, instead of selling separately a console and a 1-year subscription, they do a system which includes both the module and the 1-year subscription. TrueTech sells the individual 1-year subscriptions on the internet platform for $60, and it sells the individual modules of the console for $240. The package deal, the TriBox system, is sold combined for $250 a piece. On January 1, 2018, TrueTech delivers 1,000 TriBox systems to CompuStores at a price of $250 per system, and receives $250,000 from CompuStores on January 25th, 2018. Assuming that we've already established that we have a contract, we can move on to step number 2, which is to identify the performance obligations. Remember that to have separate performance obligations, a good or service must be distinct, with both it being capable of being distinct and separately identifiable from the other goods or services within the contract. Notice that in this situation, we do have 2 distinct goods, the TriBox module and the internet subscription. Remember, you can purchase each one of these individually. The module sold separately, the subscription sold separately, and what's more is you can use the module without having to use the subscription. So they are separately identifiable from the other goods or services because they're not heavily dependent upon one another. So this would indicate that both they're capable of being distinct, you can use them separately, you can buy them separately, and they're not heavily dependent on one another. Therefore, they're separately identifiable within the contract. They don't have to be combined for them to be one good that's being presented. Step number 3 indicates that we need to determine the transaction price. They tell us that each one of the TriBox systems, the combined 2, are going to sell for $250 a piece, and that there's 1,000 systems, so we'll multiply that out, and we have $250,000 for the transaction price. Step 4 indicates that we have to allocate the transaction price among the performance obligations. And here we're going to use the A over A plus B method, something that we talked about in Accounting 111. For instance, we looked at it when we were doing basket purchases of multiple fixed assets together for a single transaction price. Here we're doing the same sort of thing, but we're doing multiple performance obligations for a single transaction price. So in this situation, they tell us that the TriBox modules sell separately for $240 and that the subscriptions sell separately for $60. That's a combined $300. So what we'll say is we have 240 over our 300 for our first percentage or proportion that we'll allocate of the single transaction price, the $250, and we'll do the $60 B over A plus B to do our second proportion of the transaction price, the $250 here. And so we'll allocate each one of those by multiplying $250 by 80%, which is what provides for us the $200 here, and $250 times 20%, which provides for us the $50 here. So that's how much we'll allocate to each one of the performance obligations. Step 5 then asks us to recognize the revenue. Notice that one of these performance obligations is recognized at a point in time. The other one is recognized over a period of time. So because we're going to receive all of the money within January, we're still within the month of January, they tell us just above here that we received $250,000 on January 25th. We'll go ahead and take into consideration the full value of the receivable on January 1 when the systems are delivered. So the accounts receivable piece will be $250,000, which was the $1,000 times the $250 per system. We cannot recognize, though, all of that as revenue. Remember, one portion of the performance obligations is recognized at the point in time. That's going to be the module piece. Notice that the module piece, we allocated 80% of the transaction price. So we'll recognize all of this at revenue because we've now transferred ownership of the asset. But we cannot recognize the subscription-based revenue for the internet platform in which the games are played on. That 20% of the transaction price is going to be recognized over a period of time. Therefore, we credit deferred revenue, not sales revenue. And remember, deferred revenue represents a current liability. It is not a revenue account. Over time, as time passes and that subscription is then used, we will recognize a portion of revenue and decrease deferred revenue here. So the amount that we'll recognize, well, for every month, we'll take a proportion amount. $50,000 was the amount that we allocated. Divide that by 12. This gives us $4,167 per month. And so that's how much we'll recognize in revenue. This decreases the current liability here. And this increases the revenue account here. Okay, to summarize, here is our 5 steps for recognizing revenue. First step is identify the contract. The contract establishes the legal rights between the seller and the customer. Identify the performance obligation is the second step. The performance obligation is the promise to transfer a good or service. And if it's going to be distinct, it must be both capable of being distinct as well as separately identifiable within the context of the contract. If we have more than one performance obligation, we need to allocate the transaction price among those performance obligations for each one that exists. But before that, we must determine what the overall transaction price is, and this is the amount that the seller is entitled to receive from the customer. And finally, we must recognize revenue as each performance obligation is satisfied. That can happen at a point in time when control has passed to the customer. These are characteristics which represent a passage of control, or it can happen over a period of time if one of these 3 instances exists. The customer consumes the benefit as work is performed, the customer controls the asset as it's created, or the seller is creating the asset and has no alternative use for it. Let's finish off with a quick multiple choice question. Go ahead and pause this, and then we'll come back together and try it. This question says, Allen Co. wrote a contract that involves 2 performance obligations. Product A has a standalone selling price of $100. Product B has a standalone selling price of $200. The price for the combined product is $240. How much of the transaction price should be allocated to delivering product A? All right, in doing this, we're going to use the A over A plus B method. They make that pretty simple classifying each one of these products as A and B. So our calculation, we're wanting to do product A. Product A has standalone selling price of $100. We'll take the 100 plus the standalone selling price of product B, which is $200. So this gives us 1/3. We're then going to multiply this 1/3 by the 240, which is the combined transaction price. Let me make that clear. And this will provide for us $80. $80 would then be the amount that we would allocate to product A.